going to do now is I'm just going to explain the words. What I'm sure you've heard these terms thrown around, maybe in options, maybe in equities, anywhere. If you just understand these terms, you will have a very solid grasp of what is happening with options, okay? And I will show you the fundamental way to read options. So how, if somebody were to write and give you an option contract, that's what they use on the trading floors, that's what they use at brokers, where of understanding how options are written. So those of you who use Thinkorswim or are familiar with Thinkorswim or TD Ameritrade, if you wanted to search a very specific option, I will show you how to type it out, and you can look the exact options price that you want. So you don't have to go through the entire chain to find. If you know you want a specific one, I'll show you how to type that, okay? So let's talk first about expiration date. Now, what that means, expiry, when the options become worthless. So the options, it occurs on the Saturday, after the third Friday, so basically the third Saturday every month. So the third Friday is the last trading day for options for that monthly expiration, okay? And then Saturdays they expire, so you have only Friday that you can trade them. But you also have weekly expirations now. Since options have become so popular, you can trade them for Apple, you can trade them every week all the way out to 2023. So you have, I think, 6, 7, 8 weeks out options available. You have monthly options available, and you have yearly options available. Same thing for SPY, the index ETF. You have SPY, you actually have Monday, Wednesday, Friday. Next week's Monday, Wednesday, Friday, and then the weeklies, and then the monthlies, and then the yearlies. So you can see how much flexibility you have over which exact option to buy, which time frame to go out to. So that's what the expiration is. And more popular options have better expirations. Not every underlying, and not every underlying or security would have the kind of options I explained. Some might only have monthlies and no weeklies, but again, it differs. But again, you have options, you have flexibility in most cases. I use this term a lot, underlying. This refers to the stock or index or ETF that options are being traded on. So if I'm saying options on Apple, the underlying is Apple. Okay, so that's what the underlying means in this case. Okay, contracts. So you've heard me say this as well. Contract is the price for options, okay, on a per contract basis. They're quoted on a per contract basis. So that means each contract is equivalent to 100 shares. 100 shares. So you have to multiply that by 100. So let me explain what this means. This might sound a little confusing. A premium for an option will be written out as like this, okay? It means it's $2. Now, what we just learned was that each contract is equivalent to 100 shares. So that means to get the actual price of it, you would have to multiply that by 100, giving you 200, okay? So they're written out like this as 2.00, or this could be, 2.05. So $2.05, which is actually $205. So the contract is worth $205. So just know that there's a multiplier of 100 because each contract gives you 100 shares. Okay. And then open interest. Now this is very important. A lot of people ask, oh, I like the stock. I have options, and then can I trade? I'm like, I want to trade options on this. The first thing I ask is there any volume? Is there any liquidity? Like, can you get in the option and actually get out? Like, you don't want to buy something and then be stuck and not be able to sell, right? You want a liquid market. Open interest is the amount of outstanding contracts in the market for any specific option. You will see sometimes that, let's say, stock XYZ on one specific price has tons of volume and on another has nothing. It's very common in the options world. That's telling you something about the market, and that's information you can use to your advantage. But Knowing open interest is very crucial, because if you go to buy an option that has no open interest, guess what? When it's time to sell, there's no one to sell to. There's no one on the other side. So you might get stuck in a bad trade. So this is something you want to pay attention to, okay? All right. Now, a lot of brokers will sometimes have things as, buy to open, sell to close. Now, if you think about it, buying to open, sell to close, it makes sense. It makes sense. It's the conventional way, basically, that you think about stocks. You buy something, you buy to open certain amount of shares, and then once you've reached your objective, whether it be profit, loss, whatever, you sell to close the shares, to close the transaction. That's normal. That's perfectly fine. When it comes to options, this is the terminology we use, okay? It's called being a long or longing an option. Okay, let me repeat that. With options, we refer to this being long an option or longing an option. Okay, there's a very good reason for this. It can also be called buying options. You can call this buying options. That's perfectly acceptable. The reason I don't prefer to do that is because you can sell options too. And sometimes people find it confusing. How can you sell something you don't own? How am I able to sell a stock or short a stock, or how am I able to sell an option I don't own? So to avoid that confusion, we use the term longing an option. You're long an option. That means you're a buyer of an option, okay? Why? You'll see now. In some cases, you can sell to open and buy to close, as referred to as shorting. With options, we call this shorting. So to avoid the confusion of, wait, how can I sell an option? What the terminology and everything, because it's a concept that's easy to understand, but most often than not, people confuse it with, I'm selling to, like I'm selling an option and I'm out of the position. No. You're selling to open. You're actually initiating a position. So we use the terminology shorting here to explain that. So that way you understand long an option, I'm a buyer. Okay, short an option, wait, I'm a seller. So you start to build that, explanation and understanding. Oh, shorting an option. Okay, we're shorting an option. We're sellers. We're collecting print. Things like that. So it helps to differentiate this and approach strategies with this perspective, because now long strategies and short strategies are all of a sudden very easy to understand, rather than you going buying strategies and selling strategies, because then you confuse, wait, which am I closing and open? So that's why we use the term long and close. Somebody asked, is there a free place to practice trading options? Yes. So you can get a free demo account with Thinkorswim, TD Ameritrade. That's what we use in our mentorship too. You get the whole platform. It's a little complex platform, but it's a really useful platform. It has a lot of good information. So you can use that to trade like live, and you'll see some screenshots in this presentation to live trade those. But yeah, Investopedia has one. Yeah, Michael, that's a good one. Investopedia has a good one too. The only reason we prefer Thinkorswim is because it gives a lot more information, and you'll see a screenshot, but like we use a lot of the information from Thinkorswim to combine strategies. So it's nice to have everything in one place. What is the difference between index and ETF? Just the price. So the index is the overall market index. They're usually expensive to trade. So an ETF is usually tracking the index. An ETF stands for exchange traded fund. What that means is there's ETFs that track the index. So that means if the S&P index is, well, I think 4,100 something recently. So if somebody didn't want to buy that, they could buy SPY ETF for $410, 1/10 of the cost. And there's ETFs for everything. There's ETFs for, gold, oil, energy sector, finance sector, certain kinds of stuff. There's an ETF for pretty much everything out there. And most of those ETFs are very good options. Yeah, so you will have access to all this recording. So I will, you will have access to this recording, so you can check that out. But I will send over the PDF for both the presentations that I did, and I'll see if we can send Evans as well. And I'll put all those together in an email that we send out when the recording becomes available. So hopefully that'll help everyone review stuff. Okay. Next, premium. I just used that word earlier. It's basically the amount you pay for longing an option. So again, key term here, longing a specific option. That means you're buying. So if you're buying something, you pay, okay? Or the amount you collect for shorting an option. So now here you'll see how longing and shorting come into play, because when you're shorting options, you're collecting premium, which are certain key strategies. When you're longing options, you're paying premium, which are also certain key strategies that you want to know. So this is where the difference comes into play, okay? Oh, sorry, wrong tool. There we go. Strike price, a fixed price at which you can buy or sell the underlying. Again, options are very popular because they have so much flexibility. They have so many different, like I said, prices you can choose and buy from, all right? So the strike price allows you to dictate what price you would like to buy or sell the shares at. So like, unlike market price, if Apple's at, 140 or whatever it is at right now, you can buy it at that price. But with an option, you have the flexibility to, buy it at 170, 200, or $100 or $90. So it gives you a wide range of options or choices, so to speak. So that's your strike price.